Welcome back to the deep dive. So, if you've ever looked at a corporate earnings report and just felt your eyes glaze over,
Like you need a translator.
exactly, like
Yeah.
you need a decoder ring just to find the news. Well, this deep dive is for you. Today, we are strapping in for a pretty high altitude review of Delta Airlines.
Yeah, we're looking at the documents they put out on January 13th, 2026. This covers their fourth quarter and, of course, the full year for 2025.
And it's classic airline reporting, right? It's dense.
Oh, it's dense, full of operational data, guidance, and you always have that split between the official GAAP numbers and the adjusted or non-GAAP metrics they want you to focus on.
It's a lot. So our mission today is really, really focused. We want to cut through all of that, all the jargon, to get at two basic things. First, how did Delta pull off what they keep calling this durable success story in their centennial year?
Right. A good year is one thing, but can they actually sustain it?
That's the question. And that leads right to the second point. What is the actual evidence in these numbers that supports their, frankly, pretty ambitious 2026 forecast?
They're signaling 20% earnings growth year over year. That's a huge jump.
It's a massive acceleration, so we need to find the proof. We're looking for the foundation that's all built on.
Is it structurally sound for the future? Or is it just a one-off good year?
Exactly. Let's find out. Okay, so let's jump right into the heart of it, the 2025 results. The CEO, Ed Bastian, he kept coming back to two words.
Differentiation and durability.
Right. And when you look at the adjusted numbers for the full year, you can kind of see why. Operating revenue, $58.3 billion.
A huge number. And they closed out the year with $5 billion in pre-tax profit.
A solid $5 billion year.
It is, but I think, the number that really caught my eye is more structural. It's about their capital efficiency.
You're talking about ROIC.
Exactly. Return on invested capital, Delta hit 12% for the full year.
12%. Okay, so for anyone listening, why is hitting double-digit ROIC? Why is that such a big deal in the airline business?
Because this industry is, it's notoriously capital intensive. You're buying these huge multi-million-dollar assets that, they depreciate really quickly.
Right, the planes.
The planes. And historically, airlines have really struggled just to make returns that are higher than their actual cost of capital. So when Delta hits 12%, it's showing it's not just covering its costs. It's generating real substantial wealth for its shareholders.
So it's a sign that they're not just a commodity business anymore.
That's the durability claim right there. It proved they can allocate capital effectively.
And that profitability, it turned directly into cash.
A ton of cash. A record free cash flow of $4.6 billion. And that's after paying for all the planes and the maintenance.
$4.6 billion. So what do they do with all that cash?
Well, they did two really critical things at once. First, they invested back in their people. They announced $1.3 billion in profit sharing.
$1 billion.
$1.3 billion to be paid out in February.
I mean, just imagine the cultural impact of a payout that big. You're directly tying the high level of service they need to the employee's bottom line.
It creates a virtuous circle. You get it. Premium service drives premium revenue, which funds the profit sharing, which then incentivizes even better service.
Okay, so that's the bottom line. But a durable bottom line has to be fed by just a monster of a revenue engine. How did they get to $58 billion?
That's where we see the real shift in the business model. This is key. Delta isn't really just an airline anymore. They're more like an integrated travel services company. They're finding ways to monetize the whole travel experience.
Not just the seat itself.
Not just the seat.
And they always talk about their unit revenue premium, right? That they're getting more per seat than their competitors.
Yeah.
Something like 115% of the industry average.
They do. But the real story, the thing you really need to get a handle on, is this. 60% of their total adjusted revenue in 2025 came from diversified, high-margin streams.
Wait, 60%? So more than half their money is coming from sources outside of a standard economy ticket sale.
Exactly. And those streams grew 7% year over year. Think about that. When 60% of your income is less vulnerable to, a price war on basic fares,
Yeah.
you fundamentally change your risk profile.
That is a staggering figure. It really is. So let's break that 60% down. What's in there?
Well, you have premium revenue, so first class, Delta One. That grew a healthy 7%.
Okay.
But the real diversification comes from other places. Cargo revenue, which is a great signal for global trade, that was up 9%.
And then there's the one most people don't think about, MRO.
Maintenance, repair, and overhaul.
Right.
Yeah, this is their business servicing planes for other companies.
And how'd that do?
It was the star. Highest growth rate of all. It grew by 25%.
25%. So they've basically built a high-tech engineering company right alongside the airline.
A very successful one. And that's not even the biggest piece of the pie.
No, of course. We have to talk about the loyalty engine, the American Express co-brand credit card.
It's an absolute financial powerhouse. The money Delta got from Amex grew 11% last year.
To what total?
$8.2 billion.
Wow.
Just think about that number, $8.2 billion from one partnership. That's more than the entire annual revenue of some other U.S. airlines.
And it's still growing.
No signs of slowing down. They signed up over 1 million new cardholders.
Yeah.
For the 4th year in a row.
It's a perpetual cash machine.
And it really shows the value people put on the SkyMiles ecosystem. It fuels everything else.
And you can't have this confidence without seeing strong demand right now. What did the report say about who's flying?
It's strong across the board. International travel had a huge comeback, one of their top 3 years for international profit ever.
But the real bellwether is always business travel.
Corporate travel, exactly. And corporate sales were up high single digits in the last quarter.
In which sectors?
All over, really. But led by banking, consumer services, media, and looking ahead, almost 90% of the companies they surveyed expect to travel the same amount or more in 2026.
So this isn't just a vacation boom, this is structural.
It's business confidence returning, big time.
Okay, so when you have $58 billion in revenue, even, a tiny bit of inefficiency on the cost side could wipe out billions in profit.
Absolutely.
So let's talk about cost discipline. How do you run a global airline efficiently? It just sounds like a logistical nightmare.
It is a phenomenal challenge. But they really did thread that needle in 2025. Their non-fuel unit cost growth, what we call KSMX, was just 2.4% for the year.
Okay, let's pause on KSMX. For our listener, can you just break that down? What is it, and why is 2.4% a good number?
Sure. KSM is cost per available seat mile. It's the core metric. How much does it cost to fly one seat for 1 mile? The X just means we're excluding fuel because that price is so volatile. And what makes 2.4% so good is that it's below the rate of inflation, and it's within their long-term target of low single digits.
So they're growing the airline faster than they're growing their core costs.
That's it. And to do that while paying out $1.3 billion in profit sharing, that just shows incredible operational focus.
Now, they mentioned a change for 2026 and how they're going to calculate this to give better visibility.
Yes, and this is actually pretty important for analysts. Remember that MRO business we talked about? The maintenance arm?
The one that grew 25%?
That's the one. Starting in 2026, they're pulling the costs of that business out of the core airline CSMX metric.
Why would they do that?
Well, think of it this way. The MRO business has its own cost structure. It's growing really fast. If you leave those costs mixed in with the core airline's costs, it can distort the picture. It makes the main airline look less efficient than it actually is.
So by separating them, you get a much cleaner look at how the actual airline is performing on its own.
It's a sign of transparency, really. It gives investors a clearer view.
Of course, the other big help on the cost side was just fuel prices.
A huge tailwind. Absolutely. The adjusted average price they paid for fuel dropped 10% year over year, down to $2.30 a gallon.
That saves a massive amount of money.
Billions. And it allows them to protect those premium margins they're working so hard to build.
So all that efficiency plus the cheaper fuel allowed them to get really aggressive with the balance sheet.
And this is the ultimate sign of durability. They didn't just bank the profits, they used them. They paid down $3.7 billion in adjusted net debt.
Wow.
Bringing the total down to $14.3 billion and improving their leverage ratio to 2.4x.
When a company can say it has the strongest balance sheet and the highest credit quality in our history, that tells you they're positioned to do basically whatever they want.
It gives them so much flexibility, which connects directly to their 2026 plans. And that takes us right into the forward-looking guidance. The CEO used the phrase accelerating momentum.
Yeah, and the headline is that acceleration. They expect earnings growth of 20% year over year in 2026. That's huge.
It's a massive number. And to put some guardrails on that, they set a full-year target for earnings per share of between $6.50 and $7.50.
And to show they're not just waiting, the first quarter outlook is already strong. Total revenue up 5 to 7%.
Right. They're basically signaling that all that strong demand and revenue diversification we talked about, it's continuing. It's not a fluke.
But the strategy here, it goes so much further than just next quarter or even next year. You mentioned the strong balance sheet. It's letting them make decisions that stretch out almost a decade.
Which brings us to the fleet,
The new Boeing order.
a massive one. They announced an agreement for 30 787-10 wide-body jets with options for 30 more.
So potentially 60 new wide bodies, a huge commitment. But I think the detail that listeners really need to focus on is the timing of this.
Exactly. The deliveries aren't scheduled to begin until 2031.
2031. They're planning for an air travel market that is still 5, 6, 7 years away.
It speaks volumes about their confidence in long-term demand. When you place a multi-billion-dollar order for planes that won't even start arriving until 2031, you are underwriting the stability of the entire global travel market for the next decade.
They're essentially betting that the high-margin corporate and international travel they see today isn't just a blip.
It's a secular shift, not a cyclical bounce. That's the bet.
And that is the ultimate expression of durability. But while they're planning for 2031, they're obviously not taking their eye off the ball today. What were some of the non-financial wins they highlighted?
Well, operational excellence was huge. They were named the most on-time airline in the U.S. for the 5th year in a row by Cirium.
5th year in a row. That consistency is what people pay a premium for.
It is. And on the customer experience side, they've now got fast, free Wi-Fi on over 1,100 planes. The whole fleet should be done this year.
And they're still expanding, adding new routes like Atlanta to Riyadh, expanding the premium check-in areas. They even launched an AI assistant in their app.
The Delta Concierge, yeah.
All of these little things, they reinforce that high-margin strategy. They keep investing in the product to justify the premium price.
The whole system just feeds itself perfectly.
Right.
So if we pull all of this together, what's the big picture? For me, the 2025 results really stand on two pillars. First is that successful revenue diversification, that 60% number.
Right, 60% coming from stable, non-main cabin sources.
And the second pillar is just rigorous financial discipline, that 2.4% cost control, the $3.7 billion in debt they paid down.
And that combination is what de-risks the whole model. It's what makes a 20% earnings growth forecast for 2026 actually seem credible.
They're accelerating from a position of, as they said, historical financial strength. The durability is already baked in.
And that brings us to the final provocative thought we want to leave you with. We've established their confidence in the short term. The 2026 targets prove that. But then you look back at that huge Boeing 787 order.
A commitment that doesn't even start paying off until 2031.
Exactly. It suggests they aren't just managing for the next quarter or the next year. They have real conviction in the stable, profitable growth of global travel well into the 2030s.
It's a very long-term view.
Think about it. What other major global companies are placing bets on their core business that have a 7-year fuse on them? That kind of long-range strategic vision backed up by the financial durability they have today. It's rare.
It really is.
It tells us they see themselves as planning not just for the next few years, but for the next generation of global travel.
Keep an eye on that 60% revenue figure and that declining debt. We'll catch you next time for the next deep dive.